Good morning, everybody, and welcome to Tuesday Training. I hope you're having a fantastic week. As always,
we are live from Austin, Texas, right here at Insurance Syndicate headquarters, and man, we have a great show for you.
Good morning. Good morning. What is happening, man? Welcome back to Tuesday Training. Been a little bit since I've been on here live. I've been traveling a bit, having some fun. If you've been following me on Facebook at all, you've seen that I've been hanging out on the Caribbean coastline of Colombia for a while. Was up there for about 9 days, bouncing around from city to city. Went to Barranquilla, Colombia, went to Sabana Larga, little small town outside of Barranquilla where Grace is from. Went to Santa Marta on the Caribbean coast, which is a big port city, beautiful sunsets right there on the Caribbean. Rolled up to Minca, Colombia, which is up in the mountains and the jungle. Hung out there with the howler monkeys for a couple of days. That was pretty wild. Went, did some hiking, went, checked out some different waterfalls in the area. Coffee farm was pretty cool. Went and visited a 132-year-old fully organic coffee farm called Victoria Coffee or La Victoria, something like that. They also make their own local beer. That was super cool. I mean, 132 years old, like to see all that old machinery that they still had in there and how they did the process. Fully organic, like no chemicals. It's all worms and good dirt and coffee. But it was pretty cool. And then we went to Taganga, which was the highlight of the trip for me. Also another small little fishing village right there on the Caribbean coast. Absolutely gorgeous, phenomenal trip. If you followed me on Facebook, you saw all the photos and stuff, and I'm sure we got more to come on that. And if you were a traveler, I would highly recommend you put the Caribbean coast of Colombia on your trip, particularly the eastern side of it, where you get into Santa Marta, Taganga, Minca, all those little towns, Tayrona National Park. Like we went to one beach. The only way you could get to that beach was either by boat or a 2-hour hike from a drop-off point. Like there's no other way to get. I mean, I guess a helicopter could fly you in there. That's the only other way. So super remote areas, lots of fun, and I've got some good lessons today. This is a training I've been wanting to do for a little bit, and I've seen a lot of it kind of got spurred because I kept seeing questions and comments and people on Facebook talking about contracting issues, asking questions about contracting, and it's an ongoing thing. I feel like it's one of the things that newer agents are going to struggle with the most, and I would even venture to say that if it's true that 92% of agents fail in the first 2 to 3 years, which is a fact, I think contracting is part of it because they end up getting themselves into situations or relationships contractually that they don't fully understand. And then maybe it's not the best fit for them. And then getting out of that situation can be problematic. So I want to dive into contracting and give you guys a solid lesson on understanding the different contracts that exist in the life and health space, how they operate, what you should look for, what are some of the gotchas, how you make transfers if you need to, things of that nature. So probably be a little bit of a short lesson because I don't have a ton of news. I do have one thing that I want to bring up on screen real quick before we jump in. This was a new article that just came out yesterday. Boom, boom, boom. And you may have already heard about it right here, right? CBO is Congressional Budget Office. So they say that there's a reconciliation package. I believe this is part of the old big, beautiful bill that will lead to about $500 billion in Medicare cuts over the next decade. So basically about $50 billion in cuts each year. I have not had a chance to dive into all of this. Even this article really doesn't talk about much, but it is starting to put it out there. So I'll get this in the group. You guys can check it out. I will say in this article is a link to the letter that was written by the Congressional Budget Office to some different Democratic senators. That letter is right here, right? You can go through the whole thing, and it addresses their concerns on what they see. I will get that in there for you as well. This is all based around the pay-as-you-go act from 2010, as I remember, which is basically a budget neutrality act, which says something to the effect of, hey, anytime there is going to be an increase in the national deficit, this act kind of gets in the space to create some form of budget neutrality through other cuts to offset that increase in deficit. So they're saying that it could result in about $500 billion in Medicare cuts. And I also just want to put that in perspective a little bit. And I will say that from the little bit of research I've had time to do on this, because I haven't had much time, a lot of it, unfortunately, looks like it will probably be cuts towards providers. Where maybe they're not getting as much. Could also mean a cut in subsidies to some of the privatization of Medicare. We will see. I will dive into it more and bring you more. But how much does that actually represent if we're looking at $500 billion over a decade? Well, right here from USA Facts, it tells you that Medicare in 2023, or the federal government spent $848.2 billion on Medicare, or a little over $15,000 per beneficiary. So $848 billion, so if they're looking at $500 billion over 10 years, then that's $50 billion a year, basically, with some simple math. It's less than 10%. That's probably like a 7 to 8% cut. It's not outstanding, right? And if it is directed mostly towards providers, I'm sorry. They're probably used to it right now, because they have definitely been seeing their Medicare reimbursements go down over the very lengthy arc of at least the last 15, 20 years. So they may have more cuts coming to them in the near future. So I'll do my best to keep you guys up to speed on that one. Other than that, like I said, I wanted to dive into some contracting stuff today and talk about that. As always, I want to do a big shout out real quick to my buddy over at Done For You DFY CRM, Eric Fierro, good friend of mine, also a partner of mine in the Invictus Conference and a few other endeavors. But that is the CRM of choice that I use. If you're looking for a CRM out there, give Eric a call, get a demo on it, check it out, see what you think. I don't have any slides or any presentation to talk about contracting. So if you are listening and you want to pay close attention, I would highly recommend maybe you grab a little pen and paper and take a few notes on this. I'm just going to go through contracting stuff. And again, this is going to be specific to the life and health space. I know there's a lot of P&C agents in this group. Everything that I'm talking about really doesn't apply in the P&C space as much. P&C, at least from what I can see, pretty much operates on what I would call a single payer type model, right? Where all commissions are always paid to one entity, regardless of who's writing the business. And then that one entity can kick it out. So it's basically pretty much an LOA model for the most part. ACA is kind of like that too, right? Where all the ACA commissions get paid to the top level, and then that top level distributes them as they see fit. Unless you're, of course, direct to the carrier. But in the Medicare space, in the final expense space, in the life insurance space in general, in the annuity space, in the ancillary and supplemental health market space, right? So things like cancer products, home health care, accident policies, AFLAC, like all of that stuff. All of those items fall under these top categories or styles of contracts that I'm going to talk about today, right? So again, it's pretty much everything in the life and health sector runs in a very similar fashion with very few exceptions. I would say the ACA market is probably the only real exception, right? So if you're an agent in the Medicare space, this definitely applies to you. If you're an agent in the final expense space, this definitely applies to you. If you're an agent in the mortgage protection space, IUL space, this definitely applies to you. And whether you're selling Medicare supplements, ancillary health products, or Medicare Advantage, this will all apply to you. So just kind of jumping right into it. Number one, you have to understand that there's basically two types of contracts that exist in this world. And when I'm talking about those contracts, I am specifically currently talking about the contract that the insurance company provides you as the agent, whether they're giving it to you directly or you're getting that contract through a third party like an FMO or an MGA or an upline or agency of some sort, right? The carriers all create two different types of contracts. They create one contract that you could call a direct pay agent contract. That contract means that you as the agent, when you write business, you're getting paid directly from the insurance carrier. A third party is not handling your commissions, right? So if you're contracted on a direct pay agent agreement, is what I'm going to call it, with, say, United Healthcare, that doesn't mean you're direct to the insurance company. Because let's be honest, if it's an individual agent, you cannot go to United Healthcare and get a direct contract with the insurance company unless you're basically a career agent or ICA agent of some sort, right? Otherwise, if you plan to operate as an independent broker agent, you are going to have to go through an FMO or broker to obtain that contract. And United Healthcare provides that broker two different types of agreements. They can sign you up on direct pay, which means, again, when you write business, United Healthcare pays you directly, or Aetna pays you directly, or Cigna pays you directly, whoever it is. Or they have what's called an LOA, or license only agent agreement, also known in the industry as a blank agent contract. Anytime you sign a license only agreement or an LOA contract, then the upline that provided that contract to you, the broker, the agency, the FMO, whatever acronym or nomenclature you want to apply to them, they are receiving the commissions from the insurance company anytime you write business. And then they are paying you separately what they see fit. Okay. So again, direct pay agent, when you write business, you're paid directly from the insurance company. LOA, when you write business, you're paid by your upline or a third party, not the insurance company. Now, the good thing about the direct pay agent contracts, again, you're getting commissions directly from the insurance company. In pretty much every instance, you're going to get what they would consider the fair street market level or street level commissions, right? Which we know in the Medicare Advantage space is $626 in most states. There are a few states like New Jersey, Connecticut, California that pay a little higher. And then in your ancillary world, where your everything that you are getting is a percentage of the annual premium, like a Medicare supplement or a hospital indemnity or final expense or whatever, right? They're going to have a different set of commission levels that you can pick from. Average street level comp on, say, a Medicare supplement plan, depending on the state you live in, is usually plus or minus right around 20%, right? Now, really good news on those contracts that you're getting, that where the carrier is the one administering the commissions, you're all vested from day one. All of those contracts will include a vesting clause, and I have never seen one in 21 years of doing this. I have never seen one that didn't provide vesting for the agent on day one. Now, there might be a couple of other clauses to maintain your renewals, but vesting is usually day one, right? And just to clarify real quick, for those of you that may not know, I have been in the industry for 21 years. Just over 20 of those years is in the Medicare industry. And 14 of those years was working at the national level as a wholesaler directly with the insurance companies, doing product design, development, distribution. If there is one thing that I am an absolute expert on in the industry, it's contracting and understanding how products get distributed through those contract networks, hierarchies, et cetera. So going back to this again, the direct pay contract from the carrier, you're getting paid directly from the insurance company. You own the commissions from day one. Now, I said that, again, vesting will be from day one, but you might have some clauses included in that contract to maintain those renewals after day one. For example, it's probably still in there, but it's been a while since I've looked at it. As an example, Cigna supplemental benefits used to have a clause in their contract that said that you had to maintain at least, I believe it was $600 annually in renewals for them to continue paying you. Otherwise, they would just terminate the contract and keep that little bit of renewals. Other carriers, like in the Medicare Advantage world, If you want to maintain your vested from day one renewals, you have to maintain your license, your certification, and your ready to sell status. And they'll keep paying you for the business that you have on the books from years and years ago, right? So please understand that while all direct pay contracts are vested from day one, there might be some clauses in there on how you maintain those renewals over time, right? So some might, again, they might have a minimum threshold on your deposits or your renewal amount for year over year to keep getting paid. And some may have an active RTS status tied to it like they do in the Medicare Advantage world. That's a direct pay contract for the most part. That's it. I'm going to dive into them again here in a second to go through levels, releases, and some of that. But I want to jump over to LOA. And one of the problems that I have with the LOA contracts is not that they're LOA contracts. One of the problems I have is that there's a lot of agents out there that will, I'm just going to say they will absolutely bash LOA contracts. And that is a terrible thing to do because LOA contracts in and of themselves are not all absolutely bad, right? For 14 years, I spent my time working in an LOA type fashion. I vested, earned my income. I'm still getting paid for business that was written 12 to 14 years ago under my name, right? So and I had this argument in a thread recently that people think too much in absolutes in this business. Nothing is absolutely bad. Nothing is absolutely perfect or good, right? Everything is going to run on a spectrum. So you can't just say, oh, it's an LOA contract. No, don't ever, like I've seen agents run around on these forums or these Facebook groups and I'm like, hey, don't ever sign an LOA contract. That's terrible. That's bad. Maybe, but you can't absolutely say that because I know a lot of agents that are in LOA agreements that are making more money and have more vesting and more opportunity than agents that are on direct pay contracts. It's just a fact. I was one of those agents myself. I can guarantee you, right? I just said it. Like I was on an LOA agreement for 14 years. I'm still getting paid from business that was under that agreement, even though I don't work there anymore, right? And the reason why is this. Here's where agents screw up on the LOA deal. Number one, they don't recognize they're signing an LOA agreement and they don't know what it means. Number two, they're not verifying the second contract. Anytime, this is the big key, anytime you're going to sign an LOA contract, a license only agreement, and I don't care if it's final expense, Medicare, whatever. And again, I'm speaking specifically still from the contract from the carrier to you, right? I'm talking about that LOA agreement. If you're going to sign an LOA contract through any upline with United Healthcare or with Aetna or with Cigna or Manhattan Life or whoever the hell it is, there 100% should be a second contract that you have to sign with that upline, with that agency, with that FMO. And that contract would dictate the commissions, how much you're getting paid, when you're getting paid, what is the process for chargebacks and releases and all of those other, is there a vesting clause in there? What is the vesting clause? What does the vesting period look like? If you ever work with an agency that just hands you an LOA agreement from an insurance company and doesn't give you a second contract between you and them, don't sign that one. That is probably the closest you're going to get to an absolutely bad situation in LOA level. Pretty much it, right? So again, what is an LOA contract? Again, an LOA contract means when you write business, your upline or a third party is getting paid and they are now responsible for paying you, right? But if you just look at the agreement from the insurance company to you that's an LOA, it's not going to have any of those terms in it, for you at least. What are some quick ways to identify an LOA agreement from the insurance company? Super easy way. Number one, is there a W-9 included in it? There won't be because the carrier doesn't care. They're not paying your commissions. So they're not going to send you a 1099 or a W-2. They don't care. They're paying another entity. So there's no need for them to include a W-9 in there. They also don't have to include an EFT form in the contract because they're not paying you. So if at glance, you're looking at a contract from an insurance company, and in that contract, you don't see a W-9 and you don't see an EFT form, a light bulb should go off that, hey, this is an LOA agreement. I don't even have to read the legal jargon that's in there. I can tell it's an LOA agreement because there is no W-9, there is no EFT form, which means there is no method to pay me directly as the agent. Somebody else is getting paid on this contract. And I want to find out who they are. I assume it's the guy that handed this to me. And yes, Viola, I will absolutely go over that. Or Viola, apologize. I will go over that with you. That is already in my notes, so just bear with me on a second. But again, if you're going to sign an LOA agreement with the insurance company, right, that doesn't have a W-9, it doesn't have an EFT form, there should be another contract that has that stuff in there between you and your upline agency, FMO, whoever it is, right? Now, and I have to address this because it's real, some agencies, FMOs, recruiters will take that carrier's LOA contract and they'll slide in their own W-9 and their own EFT form because they need to capture that information to pay you. But they still didn't really give you a contract that explains how their commissions and how their process works. All they did was they took United Healthcare's LOA agreement and then they slipped in their own W-9 and their own EFT form. That way they can grab that data from you and pay you however they see fit. How would you figure that out? Well, the W-9 is a W-9. Like, it's always going to look the same. It's a government form. But on the EFT form, look at it. Does it have the carrier's letterhead on it? Or the footnote at the bottom? Does that form number represent probably United Healthcare? Right? Or because every carrier is going to have a form number on the bottom, a little footer that says their form number, has the date that it was approved, even on an EFT form. So don't let yourself get fooled. I mean, the best way to verify if you're getting paid on an LOA contract is to read the damn thing. Particularly read the commission section, right? There should be an article in there on commissions and how they're paid. So an LOA contract, as far as the carrier is concerned, has no vesting to you because you're a blank agent. All they're doing is getting you appointed. They're going to screen you, make sure that your background check is good, and that they can get you appointed. But anytime you write business under that agreement, the upline gets paid. So in their eyes, you don't own any business. You don't own any commissions. There's zero vesting to you. So that's why, again, I'm stressing this hard. If you're going to sign an LOA agreement with anyone, there needs to be a separate contract between you and the upline that determines the terms and conditions, how you get paid, when you get paid, what the whole process looks like, etc. That's the first one because I recruit LOAs, right? I work with direct pay agents and I also work with LOAs in our agency and our group. When I recruit a new LOA to come work with me, the very first contract I show him is the contract between me or Avila and the agent. There's no need for me to show him United Healthcare, Aetna, Devoted, Cigna, and all their contracts. Those are a waste of his time until we agree that the first contract, the one between you and me, is going to be the opportunity that you're looking for, right? And in that contract, it explains how things work at Avila, what my expectations are, what his expectations should be of me. It includes the commissions, exactly how they get paid, when they get paid. If there's a bonus structure, it includes it in there. It includes my vesting clause in there, right, for that agent. And it goes through all those terms and conditions. That's the real contract for that agent. Once they agree on that and we want to bring them the position and everything's hunky-dory, then now I'm going to set him up with his carrier contracts. And those are mostly just procedure because we have to get that agent appointed with the carriers, right? Whereas when I was at Precision Senior Marketing, recruiting agencies, and FMOs myself, everybody I was recruiting there was an independent agent that worked for themselves. They were getting directly paid by the insurance company. So there was no contract between the agent and Precision Senior Marketing or the agent and me because I didn't mess with their commissions. All their commissions were determined by the insurance company and that contract. So I would go over only that contract with them. The only other thing that we paired with it was a simple document for an open release because we believed in an open release policy. That was it. Contracts were super simple. Now, there are some insurance companies out there that actually, let me back up. Let's say it this way. Going back to the direct pay contracts, right? And again, this is all specific to life and health, Medicare, etc. There are multiple commission levels built into that contract. Everything from the agent level at the bottom to usually what's called a general agent, to then usually a MGA or managing general agent, SGA, super general agent, FMO. I've also seen SFMO, first like super FMO. I've seen NMO or NMA. Sometimes it might be FMO1, FMO2, then NMO. Like, that is not standardized. And this is another issue that agents get themselves into, is they get too fixated on the acronyms. Yes, there's a lot of carriers that do it the same way. Agent, GA, MGA, SGA, FMO, NMO. Great. It would be nice if it were perfectly standardized, but it is not. Right? Many agents will use the terminology general agent to refer to as what it means to get direct paid, and that's fine, but just understand, like, don't confuse that with commission levels and so forth. Other carriers like Aetna that use the same structure, they have a totally different set of words. AG4 is their bottom, then it's LMO, and then I believe it's RMO and PMO and CM or RMO, and then MMO and PMO at the very, something like that. So same type of structure, just a whole bunch of different acronyms and words to define it. All those hierarchies, all those commission level structures mean is that everybody in there is getting a little piece. It's a supply chain, just like anything else, right? So if you're at agent level, the person above you has to at least be at GA or general agent, I'm going to call it. If it's Aetna, it's LMO, but they have to be at the next level up in order to recruit you in an override. In order to recruit that guy, that person has to be at the next level up, and so forth. Okay? And they're going to tell you, hey, at this level, this is your commission. At this level, this is your override. At this level, this is what your commission and overrides look like. They're going to determine all that, right? That carrier will administer all of those commission levels. So let's just theoretically throw out an example. Let's say the NMO recruits an FMO, that recruits an SGA, that recruits an MGA, that recruits a GA, that recruits an agent. So there's somebody in every level down the hierarchy. That agent writes a piece of business. Everybody's getting a little piece of that commission all the way up to the top, right? Alternatively, you could be an agent that's directly contracted with an NMO who's direct to the carrier, and you write business. There's nobody in between. So that NMO is getting a really large rip because they're getting all those levels in between you and them. Reason I bring that up is because, again, I want to say that the carrier administers all those levels, right? So United Healthcare is paying the NMO. They're paying the separate override to the FMO below them. They're paying the separate ride to the SGA, the separate override to the MGA, then the GA, then the agent down at the bottom. They're handling all of that work. That's how the majority of your direct pay agent contracts operate. However, in the Medicare Advantage world, there are a small handful of carriers that will not do that. They're like, nope, we don't have a commission platform that allows us to administer commissions for multiple levels in a hierarchy. Right? For example, if you go direct, because you can go direct to Humana, unless they've changed it, and I don't believe they have, there's only 3 levels. There's agent, there's MGA, and then there's NMO. Either you write enough business to get a high-level NMO contract with Humana, or they will get an MGA level or a agent level. But that's all they're going to do. But then, under those scenarios, they're only going to deliver commissions to one entity, right? So if you're under, and I'm going to pick on AmeriLife because that's a lot of my partnerships are at. If you're under AmeriLife on Humana, they have a direct NMO relationship with Humana. But it's typically a little bit of a hybrid agreement. It's an LOA contract. All the commissions are paid to AmeriLife's administrator, and AmeriLife administers all the commissions. Because Humana will not administer commissions to multiple levels down a filter. They're going to pay one person, whether it's the NMO, the MGA, or the agent. Pick one, but we're only paying one. Devoted, same thing. Anthem or Elevance, same thing. Scan, same thing. So there's a small handful of carriers that will allow a direct contract at a higher level, but if that guy recruits agents, they're only going to pay the top level, and he's going to have to administer commissions on the downside. So the reason I bring that up is this. In those relationships, you need to look a little closer at the contract because it's going to be a little bit of a hybrid. It's going to be an LOA contract that shows that, hey, all these commissions are getting paid to this third-party entity. And they're going to have their commission structure for how they do it. For example, like AmeriLife has they have the NMO Humana contract. They're getting paid from Humana, but they have built in all the commission levels so that you can operate as a hierarchy, and you can hire, you can come in as an FMO yourself and bring in agents and agencies and so forth, and they'll handle that distribution for you, which is great. Because a lot of agents that want to recruit, especially if they want to recruit independent agents, they don't want to get caught up in commission accounting. And I don't blame them because it can get tedious. I do enough of it. But you need to look at that contract a little closer. And you need to, and when I'm saying this very emphatically, just because I know that AmeriLife contract for Humana is an LOA contract in general structure doesn't make it absolutely bad. Because there are no absolutes, and you got to quit thinking that way. All you got to do is read a few articles down, and it will tell you that contract is vested from day one through AmeriLife. As long as you maintain certification status, RTS status with Humana, even if it's not with AmeriLife, they'll still pay the commissions on the business. Not all of them are going to operate like that. So when you get into NMO level contracts, or when you're signing contracts with Humana, Anthem, Scan, Devoted, be really clear on the contract that you're signing. Devoted will administer, I believe, only two levels. They'll pay the MGA, and then they'll pay an agent. I have a direct contract with Devoted as an MGA. So when my agents on Devoted write business, they're getting paid directly from Devoted. I'm getting my direct override from Devoted. Scan, my understanding with Scan is they're only going to pay one person, the top person, whatever level they're at, and then they can handle LOAs on their own. And some of those carriers won't even allow you to recruit LOAs unless you're at the higher level. So there are some little particulars in there on some of the, I'm going to call them one-off carriers, even though they're not that one-off. These carriers are getting bigger and bigger, right? But all of your major ones, your big boys, they're all going to operate pretty much the same way, where they're going to give you a bunch of different commission levels to work with within your direct pay agent agreement and so forth. Now, how do we get those levels, right? Again, I'm still living kind of on the direct pay side right now. I'll get back to LOAs again in a minute. But on the direct pay side, how do we obtain those bigger levels? Well, if we look at the products outside of Medicare Advantage, Medicare supplements, final expense, cancer, heart, stroke, hospital indemnity, home health care, et cetera, et cetera, et cetera. Everything that when you write has a premium and you're getting paid a percentage of the premium. Those have a bunch of levels in them too. Like a final expense contract has usually anywhere from probably like 15 to 25 levels built into it from the top down. Might be as high as like 160% for the direct guy, all the way down to something like 35 or 40% at the very bottom. And they usually run in 5-point increments. How do we get those bigger contracts? One, write a bunch of business. That's usually the answer, right? Those carriers are usually only concerned about the volume of business that you write to get that contract. So, for example, if you're just Johnny Agent out there writing Medicare supplements, you're going to get the standard street level. Maybe if you work with an FMO or upline that's nice and they're a friend of yours, you might get an extra point. Right? but you're probably going to get somewhere around 20%, maybe 22, maybe 23. Like I said, if you're getting an extra point on your Mutual Omaha contract or something. And when you write business, you're going to get paid that percentage. Now, if you write a shit ton of business with them, you can argue for more. And that usually starts at somewhere north of $100,000 in premium on average. Not perfect. Some of them are going to be a little more, but I would say on average. So for example, if you write $100,000 in annual premium on Medicare supplements, you have some argument to be like, yo, can I get an extra point on my contract? You know, I'm writing a lot of business with you guys. The very top contracts are going to require somewhere around $1 million or more in annual premium to obtain those high-level Medicare supplement contracts or hospital indemnity contracts, et cetera, right? You're going to need to write somewhere around $1 million. And then, yes, you can start shopping for the top levels. And when I say top, I'm talking top under the NMO that developed the product with the carrier. Getting direct-to-carrier on those products is nearly impossible. Not impossible, but nearly. It's going to be really difficult. How do we get higher level contracts in the Medicare Advantage world? Totally different. Right? Let me go back to the other products real quick. So again, your standard life and health products that pay a percentage in the annual premium. You obtain higher levels by writing more business. Now, they don't care how many agents it takes you to write that more business. They just want more business. If you're one guy that somehow writes $1 million a year in MedSup premium, you're going to get the highest level contract out there. If you're 30 agents that write $1 million in business, you're going to get that same contract. Medicare Advantage is totally different. In the Medicare Advantage world, you obtain higher level contracts by recruitment. They want to know how many agents you're managing. And this is a problem that's going on in the space right now, is that there are carrier requirements, and then there's some FMOs that have their own requirements. And I'm not a fan of the FMOs that won't cop to it and say that, no, that's my requirement. There are some FMOs in the recruiting world, NMOs, whatever, that will unfortunately fib and tell you that their requirements, no, the carrier only allows us to do this. And no, that's bullshit. I'm just going to tell you right now, I did a video with Christian Brindle on this maybe 2 or 3 years ago where we talked about some of these misnomers. And Viola, I'm actually talking to you because you brought this up. This happened to you recently. If in the Medicare Advantage world, everybody's going to start at agent. And again, I'm in direct pay land. I'll get back to LOA again in a minute. I'm in direct pay world. Everybody, every agent that's licensed and ethical and can fill out a contract and get appointed is going to start at agent level, $626 currently for new to Medicare business. And then there's a general agent level, which is usually on average about a $50 override per app. I think Aetna at 65 in most states, if I remember correctly. Might even be as high as 80. Then there's an MGA level, a little higher, right? That's about $100 to $125 over street. And it goes on up until you get to the very top level where they're usually earning somewhere around $225 to $275 override over street. You get to those higher levels by recruiting agents, right? How many agents are you managing? Now, as long as you have at least one active downline, right? So you're first active, right? And then you go recruit someone to work with you. As long as you have at least one active downline, you can access the general agent level contract, or as Aetna calls it, the LMO. That's the first level override. There are FMOs that are going to tell you that you need 5 or 3. 5 is kind of the going number that they like to spit out. You do not need 5 agents as far as the carrier is concerned. That FMO can certainly say that, and they can tell you that, like, no, we withhold the GA level unless you have 5 agents. The problem is that some of those FMOs or NMOs or recruiters are going to fib. And when you call them out on it, they're going to be like, hey, that's the carrier's requirement. carrier won't let us offer out a GA contract to anybody with less than 5 agents. That is bullshit. I'm just going to say it as it is. It's bullshit. You only need 1 agent in your downline to get the GA contract. When Grace launched her business with Avila, I purposely also got contracted with her, even though I'm not writing business, but because I understood that as long as she had 1 other agent in her group, we can get her started at general agent and make an extra $50 to $65 an app, which was very important to us at that time to help her maximize the amount of commission she could get to help us invest and grow this business. So you only need 1 downline agent to obtain GA, period. If the FMO is telling you otherwise, those are their requirements, not the carriers. I promise. Now, to get above that GA, yeah, there's going to be some stiffer requirements. And they're not all perfect, but they're all pretty similar. For example, MGA, it's going to vary by carrier, but if you have 5 ready to sell agents, a lot of carriers will give you or help you get the MGA contract, assuming that the FMO has it and is willing to bring it to you. You get into SGA and higher level FMO levels, you're going to need some producers, and you're going to have to be putting down some apps. But to at least get yourself rolling at GA, you just need 1 downline agent. So if you're an agent out there and you're sitting at the agent level on any given carrier with you, whoever your FMO or upline is, and you go and recruit your first agent, the next words that come out of your mouth should be, hey, I'm recruiting an agent. I need to get put at GA level. I need to get bumped up a level so that I can make room to pay this guy at street level. And they should say, hey, absolutely, let's get you set up so that you can bring that agent on properly and get this thing rolling. But unfortunately, some won't. They're going to tell you, no, you have to have 5 agents before we can do that. And unfortunately, if they tell you that that's the carrier's requirement, they are not telling you the truth. That's their requirement. And they have the right to have that requirement. In the LOA world, going back to that first, actually, no, let's stick with this for a second. So again, more agents in the Medicare Advantage world means higher contracts. Now, at some point, when you get to those highest levels in the Medicare Advantage world, they're going to throw on some production metrics too. And Aetna is usually the most stringent about this, where they want, hey, if you're going to be at this MMO or RMO or PMO level, not only do we want to see that you have 25 or 50 or 150 agents, we want this many apps getting written every year as part of it. And if you're hitting both of those metrics, yes, we'll get you that highest level. But most of them are just agent count. And that is ready to sell active agents writing business, right? It's kind of weird because I would think like, hey, if you're a single agent and you are writing a boatload of business, you should be able to get a better contract on your MA. But nope, it's all based on agent management. And part of that has to do with CMS's regulations, right? Because they don't want any single agent getting more money than another single agent per application. They want it all to be flat. So the only way an agent earns more than the other agent is either A, by just writing more business or recruiting other agents to earn overrides on. Fairly simple. So going back over to LOA real quick. If you're in an LOA agreement with a carrier, and let's say you're in a hybrid type LOA, right? Because you're working with, say, a Humana or a Devoted or an Elevance that will only pay a single payer, right? A single commission receipt. They will not pay every single level. But you're still in a well-structured LOA contract that does have vesting. Like I said earlier when I opened this show, don't sign an LOA agreement if it doesn't have a secondary contract to back it up. So, for example, and they have all those levels built in, now they are going to have a little more, freedom on how to give out levels, right? So say, for example, AmeriLife's Humana contract, right? It's a single payer contract where Humana's only paying AmeriLife. AmeriLife's administering the commissions to all the agents. They did build in the full hierarchy from FMO all the way down to agent. But Humana gives them full authority you can give out levels however you want. Now, they do follow the industry guidelines. They're not going to give an FMO contract to one person. I mean, they might give it to them, like if you go sweet talk and be like, hey, I got potential. I got 180 agents on this other contract. I want to move them over here. They might start you at that level and be like, yo, you got like 90 days to start putting people on, or we're going to bounce it. I mean, they don't just they don't bastardize that contract. You know, they are very they back it up with some integrity, and they kind of keep it across the industry standard, right? So if you have at least one agent, they'll give you GA if you're producing at a fair clip. Like even if only 3 or 4 agents that you got on your crew, but you write a lot of business, they'll let you get an MGA or whatever. You can haggle a little more on those levels, etc. Now, before I get back to Viola's question on hiring and LOAs a little bit, I want to talk a little bit about releases real fast. And then I'll sew up with answering some of her questions there. Releases. Raise your hand if you've ever had to get a release. Some of you, I'm sure, have. It's not always fun. How do releases work? Well, number one, it's broken down into kind of 2 things. All of the contracts that run on a percentage of annual premium. So like your final expense contracts, your Medicare supplement contracts, hospital indemnity, et cetera, non-Medicare Advantage contracts, I should say. Pretty much every one of them, for the most part, it's not perfect, has a 6-month clause in there, or it's an understood 6 months protection, which means when you sign that contract with any broker, they're going to give that broker 6 months of protection to keep you in their hierarchy. And if you want to transfer your contract, you would need a signed release. That 6 months is based off the last application that you wrote. Okay? So let's just say theoretically you're contracted with Mutual Omaha and you're contracted with ABC FMO, and you're like, the relationship with ABC is not going as well as I thought it would. These guys are going to work with me a little better and give me some more training, maybe some lead supplementation, whatever. I want to move my Mutual Omaha contract to them. Well, if the last piece of business you wrote was less than 6 months ago, you're going to have to get a signed release from your upline in order to move that contract. If the last piece of business was more than 6 months ago, you can generally self-transfer. There are some caveats, and this is one of the industry occurrences that bugs me. And a lot of these recruiters don't tell you this. So listen up. And I'm just going to use Mutual Omaha as an arbitrary example. Okay, but this is across the board. Pretty much every carrier does this. I promise. Let's say, for example, you're working with ABC FMO on Mutual of Omaha, and they have you contracted at level 3, which is 20% on their Medicare supplements. But then XYZ FMO comes over, gets in your ear, and says, hey, I'll pay you 22% for that same business. And you're like, well, shit, why am I not getting 22 already? And it's been more than 6 months since you wrote your last app. So you're able to self-transfer. Well, guess what? You can't transfer and get a commission increase inside the transfer. They're going to have to transfer you at 20%. And then you're going to have to wait at least another 6 months before they can increase your contract level. So when that recruiter gets in your brain and says, hey, I'll pay you 2 points more, and this is true in the Medicare Advantage world too. You might be sitting at agent level and you have a downline and you're like, I can't get GA because my upline won't give it to me. They say I need 5 agents. And then that recruiter's like, well, I'll do it for you. Let's transfer your contracts. Great. But then you transfer, you're not allowed to bump your contract up in the transfer. So you're still going to be stuck at agent level with this new guy for 6 months. That was a common trick that people would use to gank agents, and I'm sure they still do it. Where I'm paying a dude 22% on a contract for Medicare supplements. Some other dude says, hey, I'll give you the 23. Move it to me. And then they move it to that guy thinking they're going to get paid more, but he never tells them that, oh, there's a 6-month wait period before I can even increase your contract. But then once it's moved over, hopefully that dude's ethical, the recruiter, and he has a reminder on his CRM that in 6 months to call you back and give you the point extra that he promised you, but he probably doesn't. If that's his recruiting tactic, let's be honest, he's not pitching real value. He probably doesn't. And then when you decide, oh, hey, well, you told me you were going to give me 23, but now I'm still stuck at 22 like I was before, and you actually suck. Like, you don't pick up the phone, you don't do anything. And then now your contract's moved over and you want to get a release and that dude doesn't release. That's a very common occurrence that still happens in this industry, I know. So again, for all of your non-Medicare Advantage contracts, there's generally a understood built-in 6-month protection. And that's based on the last time you wrote an app. If it's been longer than 6 months, you can generally transfer on your own. If it's been less than 6 months, you would need a release from your upline. And in most situations, you're going to need the release from the highest person in the hierarchy, not necessarily your direct upline. That process will vary a little bit by carrier. Some of them will want the direct one and the top level. Mutual Omaha just wants the top level, for example. I think Cigna wants the immediate and the top level signature on that release, etc. If you turn in a signed release form and they're like, hey, that's not the right guy, how do I find out who's the right guy? Just call the insurance company and be like, hey, I'm working on getting a release for my Mutual Omaha contract. I know I have to get it from the highest level in the hierarchy, but I don't know who that is. Can you tell me? And they'll be like, yeah, absolutely. You're with this group, and this is the person that signs those. Perfect. Thanks. Now you can look them up, call that person, and start haggling for the release. Now, in the Medicare Advantage world, most of the carriers now, because they're not stupid, have included a self-release process. That self-release, I think all of them are now a 90-day wait period. So now let's say, for example, you have United Healthcare with ABC FMO, and you decide, I'm not getting the level of support that I need there. I want to move it over here instead. What does that look like? Well, I either have to get a release from my current FMO, and a lot of times I need to get from the very person at the very top in order to move my contract immediately, or I can submit a quick letter to my upline or to United Healthcare, copying my upline, documenting my intent to transfer that contract. Hey, United Healthcare, I'm currently contracted with ABC FMO, but I am intending to move my contract to XYZ FMO. Please let this notice serve as my intent to transfer. They will document that, timestamp it, and now you have 90 days. If you cannot get your release from your current upline after the 90 days expires, you can move it on your own. You don't need anybody's signatures. The only problem with that is that because Medicare Advantage plans run on enrollment periods, they do have freezes on transfers. United Healthcare's freeze comes up September 1st, as an example. So anybody that doesn't have their transfer completed by September 1st will not be transferred until January 1st. So some of those things you're going to have to look at as well. The easiest way to get around all that shit, anytime you sign a contract with anybody, just ask them, hey, what's your release process? And if they tell you, oh, we always give open releases, get it in writing before you sign a contract. That's one of the reasons that I love PSM, Precision Senior Marketing, where I came from. We guarantee you, we invented the open release process. We were the first FMO to ever advocate for open releases on agents. We were the first people to put it in writing at the time you signed the contract. They still operate that way. I operate that way as well. So think about that as something to include. Now, getting back to Viola's question on hiring. Again, when it comes to hiring LOAs, you're going to have some variations there on some of the carriers. Because let's say, for example, and I'm just going to use Devoted because I know this is an issue with Devoted. If you have a contract with Devoted, even if you're direct with them, you have to be above the agent level for you to recruit an LOA. If you're at agent level and you somehow got a direct contract with Devoted where they're paying you directly, they won't let you recruit any LOAs, period. There are a few other carriers that operate this way. United Healthcare, if you're at agent level, you can't have an LOA on your team. And this is under the direct pay agent model. If you're in an LOA contract elsewhere, they're going to have a little more different flexibility and rules. But if you're in direct pay land of Medicare Advantage contracts and you want to hire an LOA, you're going to have to be above the agent level most of the time. You can hire people after September 1st, no problem. It's whether or not they're active. So let's say, for example, you hire someone after 9/1 and you're trying to get them onboarded for United Healthcare, but they're already contracted with United Healthcare. You're not going to be able to get their United Healthcare contract until January of next year at best. But if they're not active and RTS, yeah, you can hire people after 9/1 all day. I hired an agent last year, October 1st was her first day. Got her on, started getting her onboarding, ready to go. But she was not already in the business, already tied up. Like, she was super fresh, clean license. I was able to get her contracted and ready to go. So when you're hiring LOAs, or when you're recruiting and hiring any agent, more importantly, LOAs, find out what they're active with before you just go to town paying them or doing stuff. And it's not hard to look up their license and find out, except in Arizona, because Arizona does not keep and make public appointment data on agent licenses. But again, as I said earlier, in the LOA world, there should always be two contracts. There should, one, be the contract with the insurance carrier. There should, two, be the contract between the agent and the agency that they're going to be working with. So like I said, when I hire an LOA here, the very first thing I show them after the interview process and everything else, I show them our contract. There's no need for them to look at carrier contracts. They don't matter. They're blank agent agreements. They're basically meaningless other than the background check and to generate an agent number for them. The real contract is the contract between me and that agent. So that's the first thing I show them. I'm like, here's my contract. Here's how it works. I go through the whole thing line item by line item with them. Make sure they understand exactly what's expected, exactly how they're going to get paid, when commissions get paid, what the pay scale is, what the bonus structure is, quotas, minimums, vesting schedule. All that is built in there. If they agree on that and the opportunity is offered, then we'll come back and go through the onboarding process with carriers. So when you are hiring LOAs, you're going to have to be cognizant of the commission levels that you are at. So, and I'm pretty sure I responded to your post that you made a few weeks ago on this, Viola. But if you're an individual agent and you're at agent level, which you probably are if you're by yourself, and you're getting to the space where, like, now I'm ready to start bringing on agents, whether they're LOA or not, doesn't matter, really. But you're ready to start recruiting. I want to mentor someone. I want to, whether I'm hiring an employed agent or I'm going to go recruit an independent agent that I can mentor and work alongside me, and I just get a little override off of them. Your next step needs to be go and barter with your upline to get yourself moved up. Because again, as I said earlier, as long as you have at least one downline on any of your Medicare Advantage contracts, you can be at the next level up, general agent, as it's usually called. Aetna calls it LMO. That is going to give you, number one, that's going to give you the room to earn some extra cheddar. And number two, it's going to give you the ability to recruit LOAs if you're wanting to. You can't recruit LOAs at agent level with most carriers. Yeah. Final thought on that real quick that just popped in my brain, and I think it already just escaped. Oh, another cool thing about the GA level. If you are an agency, an actual corporation, and you have at least one downline agent, and you're able to get that GA level or LMO, as Aetna calls it, guess what? When you write business, you get paid at the GA level. You get an override on yourself, but you can only get an override on yourself if you are a corp and you also have one downline agent to actually obtain that level. That is the hour. I'm a little over time. If you guys have any questions on this stuff, feel free to drop them back in the chat on this video. I'll circle back and answer them as best I can. And certainly feel free to hit me up anytime. I appreciate you all tuning in, and we'll see you next week for Tuesday training. Have an awesome, awesome day.